It's going to be probably the most technical class in the course, so please bear with me with some of the details. It's probably going to be the most numerical session, but it's going to be fine. The idea and the purpose of this class is not to explain in detail valuation. The idea is that everyone in this group at the end of the course conceptually understands what is done in terms of valuation, the different methods that are available, the different ways to calculate. And most of all, I want everyone to understand the concept and be practical about valuation. If you have to do some back of the envelope calculations, or if you have to do any quick analysis, I want you to understand what are the key items and the key drivers to be able to focus on these items, to be able to produce something that makes sense and leaves you in a good position, let's say, at least if you have to react quickly to something, okay? You can go into as much detail as you like, and obviously when you do a detailed, or when you are hired as an investment banker to do a detailed valuation of a company, you're going to be doing a lot of work. But even if you do little work or a lot of work, in the end, the concept and the theory has to make sense. So this is what I want you to learn this class. And this is what I want to explain, because you're going to be presenting your valuation exercise next class. And the idea is to give you just a week, because I don't want you to spend a lot of time and a lot of effort doing many calculations and doing many slides. I just want you to produce 2, maximum 3 slides per group, which is 5 to 6 people. You can divide the work, you can do it as you like, as you prefer. But what I want you to do is to present something that you think makes sense. And if ever there are questions made to these assumptions, you have an answer, or you are prepared to answer why you chose one number and not another, okay? It doesn't need to be 100% right. It doesn't have to be perfect, but I want you to be able to reason and have some rationale for choosing the different numbers that you choose, okay? So I think we have most of the class now. Most of the class has joined. We will start with the presentation. So just to finish on the introduction, I already have you sorted in groups. For those who ask to be in a specific group with someone, you're already in that group with the people you chose. I already have the emails prepared, but I didn't send them because a few people just a few minutes ago asked me to be with other people. So I have that sorted already. So before the end of the class, or as soon as we finish the class, I will send you the emails to each group separately, saying in which group you are and what 2 or 3 slides you need to prepare for next class, okay? So in today's presentation, as in all the classes, when we review the presentation, I will show you examples of real cases where we presented DCF or comparables or regression analysis or DDM or EVA, the different methods. And then this we will do the first part of the class, and in the second part of the class, we will review an Excel template that I have prepared and that I think is very useful for everyone, where you will be able to complete the valuation exercise, maybe not for those doing trading and transaction comps, because that's a lot more straightforward, but for those doing the EVA calculation and the regression analysis, which I haven't yet explained, and you might or might not know yet, because they're not always taught in all careers or in all faculty, okay? So let's start with our presentation for today. As always, we start with our timetable, our typical M&A timetable. Just to remind everyone, we are in the initial part of an M&A process where we are reviewing figures of the company, doing the financial analysis, internal due diligence, and valuation of the company. Okay? So today's class is going to be focusing on the valuation of the company. Next class, we will have the presentations, and if we have some time left, we will start with marketing. The M&A process is divided in internal preparation, marketing, non-binding offers, due diligence, and binding offers. We are in the internal preparation, doing valuation, and there are 3 deliverables that are going to be required in this class. The first presentation is due next class, which is 2 to 3 PowerPoint slide presentation per group, which is 5 to 6 people in the group. Then we're going to have a term sheet that is going to be handed in as a non-binding offer as midterm exam, and another term sheet that is going to be handed in as a final exam, again by groups, okay? The dates for these deliverables: first assignment is for next class. It needs to be, so groups are between 5 and 6 people. The presentation is next class, 29 September, and the non-binding offers are going to be due as midterms on October 13th, and the binding offers as final exams on 17 November. This first assignment on valuation, we're going to value Banco GNB, and the valuation exercise that the different groups are going to be presenting. Groups 1 and 2 are going to be doing trading multiples and regression analysis. Groups 3 and 4, cost of equity calculation and transaction multiples. And group 5 is going to be doing the EVA analysis. For the EVA, you will need to use a cost of equity for your calculation. This is going to be prepared by group 3 and 4. So for the EVA, for the group doing the EVA analysis, we will choose when we reach that stage in today's class, and we will decide what cost of equity you will use. You will just plug in a figure for the EVA analysis. Okay, so as I said, 2 to 3 PowerPoint slides. It's going to be useful if you send also the Excel where you do your calculations in case you need to explain anything, and you need to send it next class before 5 p.m. so I have time to save all the files and be able to share them for you to present next class. Okay, so let's start with today's class. Today, as I said, we're going to focus on valuation, and I wanted to start this class discussing or describing the different types of valuations or the different valuation methodologies or methods that exist, and which one is more relevant in some cases and which ones are more relevant in other cases. But I want you to have the whole picture of what is available or what tools you can use in order to do a valuation of a company. Most of you have probably heard of most of the methods. Maybe there are a few or 1 or 2 that you don't know well, but it doesn't matter. We're going to review them. Each of them is going to have some minutes today, and then we're going to go to the Excel template where I will show you and you will see exactly the mechanics and how it works. And in that way, I think it's going to be a lot more clear than just showing some slides. Okay, so this, as I told you before, is a page coming from a valuation presentation for a client. So it's explaining the methods in a specific case. Okay, so remember, every slide that I bring to the class and that I show you in the classes are slides from previous books or presentations, real case. This is why it's called M&A case study. It's real case pages used for different clients throughout many different years and different transactions. Okay, it's not really confidential because I've removed everything that is confidential from the slides, and obviously if you have individual slides or separate slides not with a whole context, it doesn't really make sense either. Okay, so in this case we were describing the different methods used for valuation, and in particular in this first page you can see the different relative approaches. Okay, it's very important that you understand that there are relative valuation methods and that there are intrinsic valuation methods. Okay, and what's the difference? The relative valuations or the relative approaches are going to be giving you a figure or an estimate or a range of value for your company, but not based directly on your company's performance and your company's projections. They're going to be based on the market, on comparables, on different metrics that you can use in order to try to make an assumption of the potential value of your company. Okay, so what types of valuation methods do we have in this group? We have trading comps or trading comparables, we have regression analysis, and we have transaction comps. So here, as you can see, the comments on the side of the page, trading comparables approach captures the current market views on the valuation of similar companies. The regression analysis, although based on market valuation as well, captures more accurately profitability and growth prospects of the company. However, it requires a high statistical correlation to be valid. This regression analysis method we're going to see in more detail, so don't worry if you don't really understand what we are describing now, okay? And transaction comps that depend on the comparability of the transactions that are used with your company. Okay, so these are three reference valuation methods. In this case, just to give some additional information, it's not that critical here, but I think it's always interesting to show what was said in these cases or in these scenarios, okay? So for trading comps, the valuation reference point based on current market views of banks with similar business lines. So the comparable companies that were used to obtain multiples in order to value a company by trading comps were banks at that time, so we were valuing a bank, and they were banks that were similar in size, in market cap, and in the business lines offered, so in the different segments. The valuation is based on trading multiples of selected comparable listed banks. The traditional multiples include PE, which is price to equity, price to earnings, PE, and price to tangible book value, which is price to shareholders' equity, okay? So these are the two most typical multiples used to value banks or financial companies. If it were another type of company, we would probably have here price to EBITDA or firm value to EBITDA. Here we have price or firm value, or in this case it's equity value because it's a bank, to earnings or to net income, and the other one is price to equity, shareholders' equity, okay? And it's critical the selection of peers. Factors limiting the relevance of this methodology, that this bank that we are valuing it's not fully comparable with a group because it has a regional footprint, and other banks that have regional footprint apparently are not listed in that example, okay? So even though there are some banks that have the same business segments and business lines, geographically they're not present in the same areas as the bank that is being valued, okay? What about regression analysis? It captures the relationship between the trading level of some listed comparables and their expected return on equity. The selection of peers is the same as for trading comps. So they have used the same comparable companies, which are listed banks, for the regression analysis and for the trading comps. This is why I have chosen group 1 and for group 2 to do trading comps and regression analysis. Why? Because they use the same set of companies. So the group that prepares the trading comps will also prepare the regression analysis because they already will have the information. They will already have the information for the same peer group, the same group of comparables. Okay. The main factors limiting the relevance of this methodology is the selection of an adequate sample similar to the point above. And here you will see a regression analysis, in essence, is a regression line. And those of you that have already taken the courses such as, I don't know how you call it, like Mate 1, Mate 2, analysis. I don't know how much maths you do in your careers in economía or finance or the different administration, the different groups that you're in, but probably you have all discussed the equation of the line and the correlation, which is R squared. Okay, so here what is done is mixing a little bit of maths with finance, and basically what you do is you plug in a chart in an X and Y axis. In the X-axis, you will have the ROE, the return on equity, which is a profitability measure, which is the net income divided by the average equity of the company. And in the Y-axis, you plug in the multiple at which it is trading, the price to book value multiple, and you will have different dots for the different banks or for the different companies. And those dots, if you ask Excel to calculate the line or the equation of the line, it will give you not only the formula, but also the correlation. And the correlation indicates how well correlated the different levels of profitability are to the trading multiple. So how well correlated is the ROE or the profitability level to the multiple at which the company trades compared to the different other banks that you have in your peer group or in your sample. And you will see this clearly with the example when we go in the Excel. And if the correlation is high, so let's say that whenever the ROE increases, the price to book also increases in a similar proportion, and the dots are correlated to the line that is implicit to the different dots, then it means that your formula can make sense. Okay, so what is well correlated or a good correlation? If your R squared is probably above 80%, you would say there is a good correlation. If it is between 50 and 80, there is not so good correlation. If it's lower than 40, it's terrible correlation, obviously. In this case, for example, if we look at this example, the R squared was around 12%. So the selected sample indicates very poor statistical correlation, making the approach not relevant, okay? So you might as well decide your trading comps. You might choose or prepare your graph, and if you get a very low correlation, then your method is not valid. But if you get a high correlation, it's a very good valuation approach, in my opinion, because it not only includes a multiple, as is the trading comps and the transaction comps, it also includes, besides the multiple that you have in one axis, the profitability of the company. So you are comparing how much, at what levels it is trading compared to the profitability that it's generating. Okay, so, and then you will introduce the profitability, or you will consider the profitability of your own bank or the company that you're valuing in the formula to get the implicit price to book. So you will include the return on equity, and you will, in the equation of the line, and you will get, or in the graph, and you will get the implicit trading multiple or price to book at which this company would trade if it were included in that regression line. And obviously you multiply that multiple by your book value and you would get a valuation. So that's the regression analysis that we will see in more detail. Okay, what do we have in transaction multiples? This, we have discussed both trading and transaction before, so I will just show you some outputs of those pages, and we will not dedicate a lot of time there. I will dedicate a little bit more time in those methods that we haven't discussed before, okay? So the transaction multiples are implied multiples in precedent or in previous M&A transactions in the same sector as your company operates. So in this case, we were valuing a Spanish bank, a Spanish regional bank actually, and so the transaction comps used or that would have needed to be used would have needed to be M&A transactions in that segment to be ideal or to be approximate. Here we were saying the approach is not relevant as there is no acquisition of a stake, but a recapitalization. So, okay, so this was a very specific transaction, and it should not be compared to rescue rights issues. It's a very specific type of transaction, and we considered at that time that there was nothing really relevant. And this was someone's question last class. What if there are no real comparables, or what if there is no real transactions similar to this type of transaction in the market, in the country, in the sector, in the region, in the world? Maybe you don't have transaction comps. So here, in this example, as reference valuation methods, not intrinsic, but reference or relative valuation methods, we were only using the trading comps because the regression analysis had a very low correlation, and we didn't think there were any transaction comps that were relevant to include. Okay, so let's go now to the intrinsic valuation methods. What do we mean by intrinsic? What we want to say here is that these are valuations of the company based on figures or on projections of the company itself, okay? So compared to trading comps, transaction comps, regression, here, both in Gordon growth, there's two ways to call this valuation method, either Gordon growth or EVA, okay, which is economic value added. EVA or Gordon growth and dividend discount model or DDM, which is the equivalent to a DCF for a financial company, okay? So imagine here, if we were in a regular other sector company, we would say EVA or Gordon growth and DCF, okay? But it says DDM because it's a bank we're doing the evaluation. Okay, so similar to the relative approaches, for the intrinsic approaches, let's see what we considered or included in this example, or in this case, where we presented the different approaches for a client. We were saying at the side, Gordon growth model represents a good valuation reference to validate the DDM outcome. So basically what they are saying, or what we were saying at that time, is this Gordon growth model or EVA model is a good referential model to validate this other one. So basically what we're saying is the DDM or the DCF are the best valuation methods, but it is very useful to have the Gordon growth or the EVA to validate what we get in this valuation approach or in this valuation result, okay? And the DDM represents the most relevant valuation method to capture the long-term potential of the business, okay? So we're saying basically that discounted, in this, DCF is discounted cash flows, DDM is dividend discount model, but basically instead of discounting cash flows for a bank or for an insurance company, what you discount is dividends, theoretical dividends that you would be able to pay if you manage the bank or the insurance company at a certain level of capital. So everything that exceeds this level of capital would be distributed as a dividend, and then you discount the dividends as if they were cash flows, because it's similar to receiving a cash flow, and then you get your valuation. You discount it at cost of equity, not at WACC, because there is no debt in a bank, okay? So what were we saying about the Gordon growth or EVA model? We were saying it captures the relationship between the long-term sustainable ROE, the cost of equity, and the growth to perpetuity. The formula for Gordon growth, ROE minus long-term growth or growth perpetuity divided by, let's use cost of equity like this. So this is the formula for EVA. So this is the EVA method. This is the EVA formula. And basically what you say is the return on equity of the company or the profitability of the company, the long-term sustainable profitability of the company. Imagine you do all your analysis that we will explain later, and we say that the long-term profitability of the company is 15%. You say 15% minus growth to perpetuity that you can compare to inflation or GDP growth in the long term of the country. So maybe you say 15% minus 2% divided by the cost of equity, which you estimate similar to your WACC, as part of your WACC calculation. Imagine it's 10%. 10% minus your same 2%. So you would have 15 minus 2 divided by 10 minus 2. And that implied multiple. And that implied multiple, so this answer is going to be your implicit price to book value multiple. Okay? So imagine you get 2 times. Then you will multiply it by your equity and you will have your valuation. Okay? That in summary, in a big summary, is what you do with the Gordon growth. The analysis or the EVA, which is going to be done by group 5. Okay? So the big analysis is to be able to come up with the adequate sustainable ROE. And this adequate sustainable ROE is going to be done by adjusting the net income, and the net income is, the ROE is net income divided by equity. It's going to be an adjusted net income divided by the theoretical required level of equity to manage properly your bank. Okay, we will come to that. I just want you to theoretically and conceptually understand how it works. Okay, so this is the comment that we had here is it captures the relationship between the long-term sustainable ROE, the cost of equity, and growth to perpetuity. It's commonly used by bank research analysts in their sum of the parts valuations of financial institutions. If you look at analyst reports, as we saw when we read the Maestro case study, we saw at the end analyst research reports, I think 3 or 4 documents. Most analysts do valuations of their company, not always DDMs or DCFs. Many times they use EVA and they do some of the part valuations. They value the different business units, all of them or most of them by EVA method, and so they have different valuations for the different business segments that have different growth potential and profitability. Okay, I will come back to your questions in 1 minute. Let me finish with EVA. Okay, so it's a very useful complement to the DDM methodology. Sorry, there was a problem with the audio. It captures specific long-term potential of the business, and the sensitivity analysis enable refining the realistic ranges. You usually do sensitivity analysis to ROE, growth, and cost of equity, obviously, the 3 of them. So let me come to your questions. The banks don't have financial debt. Please, can you repeat the part of the WACC? Yes, the banks don't have financial debt, because if you look at the balance sheet of a bank, the balance sheet of a bank will have in the asset side mainly your loans to clients, and in the liability side, they will have the customer deposits. So basically, a bank finance themselves by capturing deposits from the public, and the money that they receive from customers as deposits, current accounts, savings accounts, term deposits, certificados, whatever type of deposit they capture, they're going to be using to lend on their asset side. Obviously, there is some issuance in the market, maybe some CDs, but it's very similar to capturing deposits from the public. There are, of course, sometimes some interbank loans, but this is not the main business of the bank. The main business of the bank is to capture deposits and with that money finance the loans. So when you value a bank, when you do the valuation of a bank, you don't do a WACC calculation because you're not going to be discounting cash flows. You're going to be discounting dividends or theoretical dividends that you would be able to give away, which is the net income that you obtain in excess of the required capital or the minimum capital that you are required to have by the regulator. Okay, don't worry if you don't understand all of these details. I just want you to understand the concept, how it works. So you are required to have a minimum level of capital because you want to protect the deposits of the clients or of the customers that you have. So the regulator will ask all banks to have a minimum level of capital. So any net income that you generate on top of that requirement of capital, in a theoretical exercise, which is a valuation, you say that anything in excess of that minimum level of capital, you could distribute as dividends. So this would be your cash flow. If you discount this cash flow, which is basically the excess of net income above the level of capital, you're discounting net income. Okay, EBITDA as other businesses, you're discounting bottom line net income. Okay, and you will be discounting it at cost of equity because you don't have in your balance sheet a debt amount. Okay, it's very similar to DCF, but you don't have the debt component. Okay, so let's go to the DDM in case there are questions. No, sorry, let's answer the two other questions and then we will discuss briefly the DDM to show you the slides and go to our template where we can spend more time, okay? So is it usual to approximate G this way, G equal ROE times retention rate? In my experience, I mean, ideally, your growth to perpetuity or your long-term growth, if we are discussing a bank, which is our case and was the case of this slide, which the long-term growth of a bank probably moves very much in line with the long-term growth of the country. This is why I said what I would use personally as I would go to any projections of GDP growth in the future, like midterm or long-term projections. And I would assume that that is the potential of long-term growth or growth to perpetuity of the bank, okay, for discounting. So I will go to Euromonitor, Global Insight, any of these sources that do GDP projections for every single country in the world, and I will take I will look at 3 or 4 year times, what are they seeing or what is the expected GDP growth for the country, okay? This is very, I mean, arbitrary. So this is why you end up doing sensitivity to a long-term growth or the growth to perpetuity. What you have to do if you have to be consistent. If you use a long-term growth or growth to perpetuity in the EVA, you need to use the same in your DDM or DCF when you're doing your when you're discounting your cash flows or your dividends. Okay, so you have to be consistent for your terminal value. I mean, or for the different formulas that you use, you should be consistent in the different approaches. You can also assume like long-term inflation rate. And obviously there is a big, you can have a big discussion on what the exact G should be or what the exact ROE should be or what the exact cost of equity or WACC should be. But this is not the purpose of focus on this class. We can have long discussions on different arguments in favor or against different specific values. The idea is that you conceptually have clear what you should include and that you are able to sustain it, that you are able to explain what you have done and feel comfortable with what you have used, okay? Is Gordon growth relevant only for the financial sector, or is it commonly used in other sectors as well? No, it is mainly used for the financial sector. It is mainly used in the financial sector. It is widely used both for banks and for insurance companies, and for, well, also like pensions and other business related to the financial sector. I will say financial companies, yes. You can always use it for other sectors, but it is not commonly or widely used. Most other sectors would probably focus more on EBITDA generation than on ROE. In financial sector, you use a lot the ROE, which is a return on equity, because both in insurance companies and in banks, you have regulatory capital, minimum regulatory capital. So you want to introduce your equity in the formula, which is not necessarily the case in other types of companies where EBITDA or income statement is basically enough. Obviously, as well, you will include your capex and other things that you not necessarily include here, but you will not have the regulatory aspect or requirement to hold a minimum amount of capital. Okay. The present value of cash flow represents the intrinsic value of the entity in question. Obviously, if you are discounting cash flows, this is cash flows generated by the company. So the most relevant approach, the most approximate value that you can get for your own company is the cash flows that you expect to receive for that company. Based on 8-year forecast of earnings generation, this was in that particular example, we used 8 years projections. Usually you use at least 5. If you don't have much information, you can do it with 3, but ideally at least 5. Projections are based on the bank's business plan and advisors' estimates, and there were 2 scenarios projected, a management case and a downside case. The management case included the business plan for 2011 and until 2015, and then a normalization done by the advisor between 2015 and 2018. And the downside case was even more pessimistic, and it was all done by the advisor. The discount rate reflects the institution's business and risk profile. Okay. What is the relevance? It's the most relevant valuation method, and it's the only one that takes into account the specificities of the business, the recurring profit generation capability, and the intrinsic growth potential of the same company. The precise methodology sensitive to critical parameters. Okay, so it includes balance sheet growth, revenue and cost patterns, the required equity, and a specific discount rate. Okay, the other ones don't project balance sheet, don't project P&L. There is a sensitivity analysis that allows you to define a valuation range with a realistic group of scenarios. And it captures the specific long-term potential of the business. The other ones, Gordon growth as well, but the other ones are more static, let's say, are based on the current trading levels or the expected EBITDA or PE or price to book in the next year, but usually there are no more projections than that. Okay, so these are the pages that you will need to present. So I will go quickly through them to go to the template, which is going to be the backup for these slides, okay? So for trading comps, I will just quickly shift through these ones and then I will come back and explain the details, but I want you to, okay, I want you to look at this. So group 1 and 2 that will do trading comps and regression analysis will present one page with trading comps like this one, I mean, it can be simpler, it can be more complex, but I think this is as complex as it gets. So it's probably going to be a lot simpler. It's probably going to be one table and then the calculation, okay? And the regression analysis is going to be another page that is going to have the graph with the regression line that we mentioned and the table. For groups 1 and 2, there will be the trading comps page and the regression analysis page. We will come back, don't worry. For groups 3 and 4, there will be the cost of equity calculation. This one is very detailed. You will probably have something more in line with the table below. So this is just real case scenario examples that we will discuss what was done for everyone's information. But what I want you to produce is something similar to the table below, okay? The cost of equity calculation. And the transaction comps. So the transaction multiple table, okay? And the last group, group 5, will prepare the EVA analysis, which is going to calculate the adjustment or the normalization of net income, the adjusted or normalization of shareholders' equity, and the ROE, which is the net income divided by shareholders' equity. Don't worry, because this one looks a lot as if it is a lot more work, but you will have the template and there are only a few lines that you need to complete, and then you will hopefully understand how everything works, okay? And then the output page, where you will do the ROE minus G divided by cost of equity minus G. You will get your implied price to tangible book value multiple, which you will multiply by the tangible book value or the book value of Banco GNB, and you will have the value. And also in the Excel, you will see, you will have the sensitivity tables to show the output value for the different levels of ROE, the different levels of cost of equity, and the different levels of long-term growth, okay? Also, for everyone's information, and this is not required for the different groups exercises, but I will share with you in the template as well, the template for a DDM valuation, which took me a long time to do a simple DDM template or DCF template, because usually the valuations done by investment banks are very detailed and very complex, and you don't only have one line for loans and one line for deposits. You will have many different lines to estimate the different types of loans, the different types of deposits, the different interest rates per type of product, the different amount or volume of deposits or credit in different currencies, in dollars, in soles. So obviously this is an extremely simple template that you can, if you want, use for the midterm exams and for the final exams. If you want to have references on a better valuation to be able to present your offers, you can use it. You can just have it as reference, or you can have it for the future to use for yourselves. It's as you prefer and as you like, but I will share with you, and also I will share with you when we discuss now the template, I will show you how it works, okay? So basically what we have here in the DDM valuation is a page showing the key balance sheet figures, then the key P&L figures or key income statement figures, both historical for a couple of years and then projected for 5 years. And then below, there are some key assumptions that are used to project these two financial statements, okay? So the assumptions below, the loan growth, the deposit growth, the margins, the cost of risk, the non-performing NPL ratios, etc., are used to project the figures above. So for the projections, based on the ratios that you get for the historical figures, you use them, and based on the knowledge of the company and what you expect for the future, you use them to project. Once you have your projected balance sheet and P&L, you calculate the minimum required capital according to what regulators require, okay? And based on that level, which is the required capital, you will compare it to your current level of capital, see if you have capital in excess or in deficit, and then based on the net income that you generate year by year, you will see if you have any potential to distribute dividends or not, and those dividends or theoretical dividends to distribute, you are going to be discounting them as if they would be cash flows in a regular valuation, in a regular DCF. You will discount them at a cost of equity, equivalent to the WACC that you would use to discount a DCF, and you will come up with your valuation, both of your cash flows and of your terminal value. And then you will have your valuation and your sensitivity tables based on, doing sensitivities to discount rate, growth to perpetuity, and here we had long-term ROE because we were using, I think, ROE to calculate that terminal value. You can also base it on the last year's cash flow, okay? So this is in summary the different valuation methods, okay? I will quickly scroll through these pages that I just discussed, and I will give you the key messages that were provided in each case when presenting these valuation methods to different clients. And then we will go to the exemplate to discuss what you need to prepare, okay? So here we were discussing trading comps, okay? And from what we can see here, we were doing the valuation of a Spanish bank, okay? So what we were including as trading comps or trading comparables or trading listed banks in the Spanish market, we were considering this set of banks: Santander, BBVA, CaixaBank, Bankia, Popular, Sabadell, Banesto, Bankinter, Banca Cívica, and Pastor. All the listed banks, all the listed Spanish banks at that time, in 2011. So we had their share price, their market cap, and the different multiples. PER is, in Spanish, PE, or price to earnings, and price to tangible book value is price to book value, so price to shareholders' equity. So these are the different multiples that are being used for these trading comps, okay? For PE, we had figures for 2011, 12, and 13, so 3-year projections, because there is very good coverage of Spanish banks by analysts. So there were analyst projections of earnings. So we had trading multiples or projections for Spanish banks for 3 years, okay? So if you look at the median or at the mean, in the first year, the expected PE multiple was between, let's look at the median, okay, was 11 times. For 2012, 10 times, and for 2013, 8 times, okay? What about price to book? If we look at the median, they were trading at that time below 1 time. They were trading at 0.77 times price to book. Why? Because this was a very difficult time for of the market. This was 2011 for Spanish banks, okay? And so we were saying the median of price to book was 0.77 times. You would usually expect banks to trade at least above book level. Here they are saying that they don't give them even credit for the book value that they have or the equity hold, okay? A very specific case. But thinking about the reality now and the current situation, given the pandemic and the market expectations currently, I wouldn't be surprised that banks were also trading now below 1 times book, okay? And here at the end of the table, we had the return on equity, which is just referential, just to look at the peer group. So you could say, okay, the trading range of these banks in terms of price to book goes from 0.42, the lowest, Banca Cívica, to 1.06 times the highest. And is this correlated to the ROE? Well, the one that is trading highest is giving a profitability of 17%, while the one that is trading lowest is around 8%. It's not directly correlated, but obviously the ones trading with lower profitability are also trading relatively lower, okay? So based on the analysis on the top, the valuation of the bank that we were doing is done on the bottom. So this valuation in the left, or this box in the left, is doing the valuation based only of 3 peers that says Bankia, Cívica, and Pastor. So taking only the Bankia, Cívica, and Pastor multiples, which are probably the most similar banks to the one that was presented, we get a different price to book and PE multiples. Let's focus at the price to book, 0.49 times, which is the same one as we have in this column here, 0.49 times. And you say, okay, so based on 0.49 times, if we take the book value of our bank, which is 1,473, we have an implied value of 717. Okay, so this is what you will have to do. You will have to get the multiple, you will have to multiply it by your equity, and you will get the valuation or the implied valuation for your bank, for Banco GNB, based on the comps that you consider for Banco GNB. And the table in the right is not using only Banca Cívica and Pastor, but all domestic banks. So what is it using as price to tangible book? The 0.77 times. This 0.77 times is multiplying it by 1,473, which is the book value of the bank, and it's obtaining a valuation of 1,141 million for the bank. Okay, so what are the comments? Spanish domestic banks are being valued by the market in light of potential impairments. Focusing on price to book value, the PEs are not relevant. Okay, so it was a time of impairments that we discussed last time, which is losses that you have to assume. So it's a difficult time for banks at that time. Due to substantial different business and geographical mix, Spanish global banks are not considered. We believe Bankia, Pastor, and Cívica are the most comparable banks to Banco Ejemplo. This is obviously not the real name of the bank. This was changed for confidentiality reasons. Banco Ejemplo valuation based on current trading comps, market multiples points to 717 million based on Bankia, Cívica, and Pastor. Okay, this would be a very good summary of a trading comps page that shows a lot of analysis and calculations for referential valuation. Okay, what about the regression analysis? In this example, again, we had in the x-axis the return on equity, the return on tangible equity, but you can just say return on equity. For 2011, what was expected for them in terms of net income and equity, okay? So we can see that the return on equity goes from 2% to 8%, okay? What is the price to book value in the y-axis of the different banks? They're all between 0.3 or 4 times and 0.8 times. Based on all these data points, come up with a regression line. And this regression line, which is here, y equals 2.87x plus 0.448, that gives an R-squared or a correlation of 12%, which is very low, which is what we discussed, okay? And at the right, you see the market cap of each of one of these companies and the tangible book value used, the return on equity, and the price to tangible book. Okay, so the X and the Y axis. And in the comments we say, price to book and return on equity regression analysis would point to a valuation of 766 million with an implied price to book of 0.52 times. However, given the R-squared of the selected sample is around 12%, we consider the approach not relevant. Okay, so it's very important for this approach to have a strong correlation. Okay, here we have an example page of cost of equity. Okay, in reality, you can just do a cost of equity as per the table below, which is the risk-free rate plus the beta times the equity risk premium, and you would get your discount rate. And here you have some comments on, in that case, what was being used. So the 10-year Spanish government bond, the beta was based on the average of those specific Spanish banks, and the equity risk premium was taken from Bloomberg as an average of Bloomberg and Ibbotson on to specific dates or times close to the valuation date, okay? And you come up with your cost of equity or your discount rate, as I said, not a WACC, but a cost of equity, okay? But here what we did was a more in-depth or detailed analysis that you don't need to do for the purposes of this exercise, but it's useful that you, that I can call to you for additional information. And here what we were doing was we were calculating since we had a lot of information because we had a lot of listed Spanish banks and beta information for all of them, what we used was we took the lever or the betas that were reported, we unlevered these betas based on the assets and the equity of the different companies or the different banks, and we calculated the leverage factor for each bank that we could then use for the valuation of our bank ejemplo or bank example. We use the average levered beta for the market, but then we said, okay, we will calculate it or we will deleverage it based on this deleverage factor. That is, since we didn't want to just average betas, what we did is we based it on the size of the debt to calculate the leverage factor that was corresponding to each one, and then calculated an adjusted lever beta. If you are more interested in this kind of analysis, let me know. I can share with you more detail, but this is just to show you an example of how this sort of information is shown in a real case scenario, okay? So basically, the beta that was the average obtained for the different banks was 1.07, and applying this leverage factor, we arrived at, which was 7.8%, we arrived at an estimated beta, which was levered of 1.03, which was the used for Popular, I mean, based on these banks, but it was used for doing the calculation of cost of equity for Banco Ejemplo. And we came up with a cost of equity of 12.5%. So the comments say, Banco Ejemplo estimated beta of 1.03, Banco Ejemplo cost of equity or discount rate points to 12.5%. Okay? Then, transaction comps. We chose transactions between 2003 and 2010, so for the last 7 years. The different M&A transactions in the Spanish banking market, so we had Barclays acquiring Zaragozano, Sabadell acquiring Atlántico, Urquijo and Guipuzcoano, and Credit Mutuel acquiring Banco Popular. All of these transactions done for majority stakes, because it's important if you're acquiring a majority or a minority stake in order to be comparable. The implied values or the transaction values for these banks and the implied multiples, price to book and PER, which is price to E or price to net income price. Okay? Based on these different transactions, we came up with a maximum, minimum, and an average or a median or a midpoint. In this case, the price to book was 2.14 times and the PE was 25 times. The multiples of implied in acquisitions of controlling stakes in the Spanish banking market have been at around 2.14 times on average and 25 times on average. This approach is not considered as relevant as this transaction is a recapitalization. So the valuation of Banco Ejemplo was done for a recapitalization process, not for an M&A transaction, so it was not really that relevant to consider transaction comps. And the situation of the bank at that time either, but that you don't necessarily know. Okay, what about the EVA analysis? Okay, for EVA analysis, conceptually what I told you was that first we normalize net income or we adjust net income, then we adjust equity, and then we come up with an adjusted or adjusted net income and equity, and we calculate the adjusted ROE, which is the net income divided by the average equity. Okay, what were the comments here? We assume a normalized return on equity level of 12%, which is this one at the bottom. The 190 million capital excess, this is going to be added at one times when you see the formula, okay? So there are some very specific comments that I'm not going to go into detail because I don't want to be more confusing. We will go for this example to the template, okay? And then we had the output page when we were saying, okay, at this level of ROE, 12%, with a long-term growth of 2% and a cost of equity or capital of 11%, we come up with a price to tangible book value multiple of 1.11 times, okay? This we will multiply by the equity and we will add or subtract any excess capital and we will come up with a value of the company according to the EVA. And then the output sensitivity tables. And to finish with the slides, the DDM calculation output that we discussed previously. So the balance sheet, the P&L, the assumptions, and here in the comments we're saying the loan book and deposit growth rates are lower to sustainable levels, lower margins and efficiency improvements assumed, the required capital in the adjusted plan is above the regulatory minimum, which is 9.8%. And then we have the net present value or the DDM value, and we say the valuation of 123 million is 1.0 times price to book. It assumes a cost of equity or a discount rate of 12.5 and a long-term growth of 5.5%. The long-term sustainable ROE of 13%, and the valuation is done as of 31 December 2011. Okay, so with that, we finish our presentation. Hopefully, you get a good or at least better idea of what I tried to explain. And now we will look at our template. So in this template, you will find the cost of equity, a page for regression, a page for EVA, and a template for the DDM that you don't need to use for this valuation exercise, as I said, but that I want to share with you and that you can use if you like when we do the non-binding offer and the binding offer to be more precise in your calculation. Here you have a template where you have a bit more detailed cost of equity and the sources that can be a reference for you. To calculate the cost of equity, you will have the risk-free rate, you will have the country risk premium for Peru to be able to have the risk-free rate for Peru. You will have to include the beta, the market risk premium, and if you like, any liquidity or size premium. Okay, I trust you have already had your valuation classes and you are able to understand what we are saying here. If not, let me know if you have any questions, but in any case, you have here below the different sources that can be used. If you don't find something, don't worry too much. Try to be practical, try to make assumptions, and try to be able to prepare to explain why you took these assumptions. This is what I'm most interested in, okay? Obviously, the 10-year treasury is going to be a lot higher than this level. Now it's at current time lows, and obviously this will be adjusted, but here you have an old calculation of cost of equity, okay? Need to just update it for the group that is going to be doing cost of equity. Okay, for the group that is going to be doing the regression analysis. As I said before, and I'm going to explain what is included in this page, and then I'm going to zoom in, okay? So here you have, for the different banks that you select as your comps, imagine you have here 8 banks. Imagine if you have only 4, you only include 4. If you have 3, you include 3. If you have 10, you include 10, okay? This is just for reference. You will include the ROE of the last period that you have available, if it's a full period for 2019, or you might, in the SBS, you should already have the figures for probably July 2020, so you can use 2020 figures. Obviously, use not the return on equity for the period, but the return on equity adjusted to a year. I think it's already usually reported that way, but just in case. And the price to book value that you will have from your trading comps template. So in this example, we had 8 banks. You plug in the ROE, you plug in the price to book. So the only figures that you need to plug in are those highlighted in yellow, in light yellow, okay? So are these ones. And immediately you will have in your chart the banks and the figures updated. So if, for example, for bank 1, I change this to 20, then my bank 1 will appear in 20, okay? If I have it in 10, then it will, 10 is not in the table. So if I have it in 12, it will appear in 12, okay? So, it in 10, I think. So just change the range or the axis if you need more or less different range than the one is here. And you will also have your equation appear and your correlation. So in this example, I just plugged in figures, but in this example, we have a very high correlation of 99%, okay? So this would be totally valid. Here, you will have the formulas for the slope, which is at 10.33, the y equal mx plus c in the equation of the formula, this is the slope. which is the 10.3, and you have, sorry, formula here. And you will have the formula for the intersection, which is the C, which is the 0.43 in this example. And the R square as well, the correlation here as well. Coefficient R square, which is the 99.7%. Okay, so based on the slope, the intercept, and the R square, what you need to include is for Banco GNB, the net income, for the two last periods, so maybe 2019 and until July, annualized July 2020, and then the equity for the last year and the equity for the last period. So you might have the equity for at the end of 2019 and the equity at the end of July 2020. Okay? Based on these figures, you will calculate, the template will automatically calculate the ROE for the bank. So the net income divided by the average equity. And it will give you a range of +1 or ±1. So you will say, okay, imagine this is the ROE that is generated by Banco GNB. Okay, so imagine these are real figures, and Banco GNB so let's come back to what we had before in the template. This you will adjust, but imagine Banco GNB generated a net income of 120, and the average equity, and the equity at the end of 2018 was 600, and at the end of 19 was 700. We will say that the ROE for 2019 was 18.5%. So imagine we were in the scenario and we were saying, okay, we'll take a range of 1%. So it will go from 17.5 to 19.5. At this 18.5 level, we would be here. So if we go to, it will be an implicit price to book of 2.30 something. We have it here. So this is taking basically the slope and the intercept of the formula, and it's calculating what would be the implicit price to book for this level of profitability. Okay? For this implicit price to book, it will multiply it by the book value, which is the equity, and we will have our valuation. Okay? So it's going to be very simple if you follow this template. You only need to complete profitability and multiples, and then for our own bank, net income and equity. Okay? Let's go to the EVA. Okay, what about the EVA? As I said before, we will be doing an adjustment to equity, an adjustment to net income, and then we will calculate our adjusted return on equity, which we will then include in our Gordon growth formula, which includes the ROE, the perpetuity growth rate, and the cost of equity, and we will calculate our implied price to book value multiple, which we will multiply by our equity value, and we will get our valuation. And then based on this, on different ROEs, cost of equity and growth rate, we will get our sensitivity tables. Again, in this example, or in this valuation method, you will complete what is considered in yellow or highlighted in yellow, okay? You will only need to complete what is highlighted in yellow. So shareholders' equity, dividends if they are available, if not, it doesn't really matter. As I said before, I want you to focus on what is critical. and what is relevant for valuation. So if you see that the shareholder's equity is 700 million and the dividends are 1 million, then it doesn't really have an impact, no? So please focus on what is really relevant, okay, or most important. Okay, so how are we I want first to explain briefly the concept of the EVA, as we said before, was to adjust equity to the required levels. Why? Why are we doing this analysis of adjusting equity, adjusting net income, and finding an ROE that is sustainable or that is that we think is going to be possible to be acquired by this bank in the future? Basically, what we're saying is, okay, banks require to hold a minimum amount of equity in their balance sheet, right? So you are not going to be doing the same valuation to a bank that holds capital in excess of this minimum required capital, because they might be holding too much capital and they could be putting it to work instead of holding it in the balance sheet without being used, or they could be having too little capital and they might be risking to be at a deficit or in a problem with a regulator, and they might need to be doing some capital increases in the future. So the capital level is very important. And the capital level in your formula, which is the ROE, is the E, which is the equity, okay? So basically what we are saying is, in order to do a valuation that is relevant for a financial company, we need to fix the minimum capital requirement, or what we think is appropriate for this bank to hold, okay? And this minimum capital or requirement, as the regulator requires a bank to hold a percentage of its assets as equity, okay? So the requirement of equity is calculated as a percentage of not only the assets, but the assets with a risk component, okay? So it's not the same to hold cash in your balance sheet or in your assets than to hold loans in your assets, and it's not the same to hold loans to large corporations than to hold loans to SMEs or micro companies in doing microfinance. And it's not the same to hold real estate loans than to hold mortgages, okay? So the assets are weighted or risk weighted, and then the regulators require the banks to hold a percentage of these assets or of these risk-weighted assets. This is a figure that is disclosed, that is reported by all banks, okay? And the regulatory requirement is to hold 10% of risk-weighted assets as equity, okay? So basically, what we're going to say is, the regulator requires 10% of assets or risk-weighted assets to be held as equity. We are going, and the system average is more or less around 11%. So we will say that it is appropriate that this bank holds 11%. Okay, so we will calculate required equity or the minimum equity or the denominator used in our formula in ROE as the 11% of our risk-weighted assets. Okay, so the theoretical minimum equity that we think is appropriate to hold. And whatever is in excess or in deficit of this capital compared to what we hold, we will consider the excess or the deficit. Okay, but is it fair to put all the banks in the same level and to value them all at 11% of the risk-weighted assets or of their assets if they are above or below? No, because those that are above, those that are below should be penalized. We're saying, okay, they need to hold more, and those of them that are above should be benefit because they already have this capital. So the adjustment that we're going to be doing for the adjustment done in equity is going to be done in the numerator. So it's going to be done in net income. So for equity, we're going to assume this level of capital, and for net income, we're going to adjust the net income that the bank generates by assuming that the excess or deficit that they had in equity, it's going to become a theoretical debt, and it's going to have a cost. And this cost of debt multiplied by the excess or deficit is going to adjust the net income. Okay, it sounds maybe a little bit confusing, but it is a slight adjustment done in net income, and to be able to take minimum required equity as equity or as your denominator. Okay, so if we look at what group 5 needs to do, they need to find the shareholders' equity, so the equity in the balance sheet for the bank in the last 3 periods, which is found in the SBS. Here you have the link in the last period. So go to this link and you will find in December 2017, in December 2018, in December 2019, or you can look at December 2019 and July 2020 equity. And then don't worry about dividend intangibles. If you find it easily in the annual accounts, then include it. If you don't really worry about it. It's a minimum, but here you have the full template to be able to do it, and you will come up with the equity value of your company. You will look for the risk-weighted assets that are reported also by the SBS. You go to that link, and you will divide whatever is in D by 0.1, or you will take 10% of that, divide by 10%, which is a requirement, and you will have your risk-weighted assets for GNB in the different periods. Okay, this is all you have to complete. You will come up with what is the equity divided by risk-weighted assets of your company or of your bank. We will say that the regulator requirement is 10, so you want to be slightly above, so you will require 11%. And this is going to be the calculation that comes up directly in your template of the equity that you're going to use as denominator in your formula. You will have a deficit or an excess of capital. Okay? And then we will adjust the net income. So we have included until now shareholders' equity value and risk-weighted assets. We will include a third figure that is going to be the net income of the bank. You also get the net income from the P&L in these links for the 3 different periods. And then you will assume a cost of debt. Okay, right now in the market, the rates are really low, so this I would, instead of 5, probably assume something around 2%. A tax rate of 30%. This I would keep like that. If you want to be more precise, or if you want to have a different explanation, you can. If not, it's fine. And you will find the adjustment that needs to be done to net income, as I explained. It will be multiplying this cost of debt by the excess or deficit of capital that you have. And depending if you have an excess or a deficit, you will have a small adjustment to your net income. Now we will have our adjusted return on equity, taking the adjusted net income divided by the average equity of the required or estimated required capital. Okay, so this is the adjusted ROE. If you look at the line above, you would have not the adjusted, but the real ROE, which is the net income divided by the real equity. But we focus on this adjusted ROE. And here is where I want you to do the thinking and the analysis. Imagine you get these levels of adjusted ROE, 9%, 18%, 23%. What are you going to assume as sustainable ROE? Because in the end, you want to find 3 figures, right? The sustainable ROE, the perpetuity growth rate, and the cost of equity, which are the 3 figures that will be used for your Gordon growth or your EVA formula. So with this, obviously these figures hard-coded here are not relevant. We have equity of 10, we have risk-weighted assets of 100, and we have net income of 1 or 2, 2.5. You will have real figures here, okay? So the ROE or the adjusted ROE that you get here and the evolution will give you the indication of what you potentially or could potentially use for the future. If you have been able to generate a profitability of 9, 18, 23, maybe historically you were at lower levels and you are now at better profitability levels, 18 to 23%. Maybe you might think that your long-term sustainable ROE should be more in line with 20%. So conceptually, what would you do? I would say if I had this analysis or these results in the analysis that I did, I would say, okay, this is probably a bank or a company that is improving their profitability. So maybe they're coming out of a crisis, or maybe they were growing and now they're sort of stabilizing, or maybe they have been improving the way they manage their cost structure, or maybe there has been something happening that has made the company change or improve their profitability levels. This, I would try to understand what is happening by looking at least at the P&L. The other thing that I would do is I would probably try to analyze what's happening in the sector. So I would go to the SBS, to these formats. They also have some formats that include the ratios of all the different banks. So I would look at what is the ROE level of the average of the sector. What is the ROE level of competitors? For example, this kind of analysis I would do if I would be doing an in-depth analysis of or an EVA analysis. So I would say maybe competitors are a profitability level of around, in average, 20%. Okay, so maybe in this case I would consider more sort of a 20% sustainable ROE. If I think I'm able to explain and justify and give some explanation or some backup to why I chose this level. Okay, in this case, what we were saying is, okay, I'm taking the average of what they have been able to do, which is 17%. I will take this 16.9%. I will assume the long-term growth of Peru that was at the time 3%. I will assume a cost of equity of 11%. And then you get everything else as an output, okay? So basically what the group, but I want you to understand what you're doing, what the group needs to include is the weighted assets, the net income, and then come up with the ROE that they would choose based on the results that they get, the perpetuity growth rate, and I would say that for this example, we can use a cost of equity of 10%. Okay, so the group doing the EVA, you can use 10% because we are just going to use this as an assumption. Okay, when groups 3 and 4 give us more detail and more insight as to what the cost of equity is, we can adjust this level. And then the different groups come up with their value. Okay, so you will get all the value and the rest of the analysis an output. This will be what is going to be taken as equity. This is the excess or deficit. This is the implied multiple that you get from using the Gordon growth formula. And this is the implicit valuation and multiples. And these also are the sensitivity tables. In order for the sensitivity tables to work, you need to change the ROE and the growth rate and the cost of equity that you have in these tables. Okay, so for example, you will need to change here. The growth rate we set 3, that's fine. The cost of equity we set 11, so you will need to change 11 here, change it here, and then it all works. Okay. I think there was a question because, so you usually the average first and then modify the weights according to criteria. No, not necessarily. It depends on, I mean, when you do this kind of analysis and you're doing at the same time all different or many other valuation methods, you will obviously have a much better understanding of the company and what has been happening. You will not only be taking the equity value, the net income, and you will have read about the performance of the company. You will have analyzed the P&L. So probably if you have the first year a 9% ROE and the second year an 18% ROE, you probably already know what happened. What is the explanation for that? So you might be in a position to say if it's more relevant to assume 9% or 23% in the long run or in the long term. You might have the opposite. You might have a company that had a profitability of 25, and then in the third year they have 5. So what are you going to consider? 5? Is it too penalizing to consider 5 if they have been able in the past to do 25? So you need there to position yourself in the specific company to which you are doing the valuation, and then you need to find the explanations. And the explanation might be, this year we had to assume a large impairment that is going to be a one-off, that is not going to be repeating in the future. So you might be able to assume that maybe the long-term profitability of that company is in fact 25, and that they have been able to do it in the past many years, but this last year was something specific, and it's not fair to value the company at 5% if really they have been able to do 20 all the time before. But you have to be cautious as well that management are being fair as well, and that maybe not only the reduction is not only that impairment, but maybe there is more competition. Maybe they have not been managing well their portfolio. Maybe so. Obviously, there is a lot more analysis to be done. What I want you, for the purpose of this exercise, is to be practical, is to calculate the figures, to understand more or less what you're doing, and to try to come up with an explanation of why you chose to use one figure and not another one. I don't expect you to do a very detailed analysis, in-depth explanation of the last 3 years or 4 years of the company. No, I want you to be practical and to try to let the figures give indication of what do you think happened, why are you assuming this, or why would you take the ROE of the last period and not the last 3 periods. Or maybe you need to do a normalization and say, look, in the future, I think this bank is going to be getting closer to what the other peers that are already managing well this company are doing. So it's also, again, very arbitrary what you consider. But what I want and what I think is important is that first you understand the method to value, and then that you are able to come up with your backup or your explanation if you were to defend this valuation method, okay? If you are using something, why would you choose it? Or if you didn't find it, what would you try to find that you think would help you have a better understanding or valuation? That would be the questions that you would probably ask either management or the owners or someone in the sector that will help you come up with a better valuation or explanation. Okay, why do we need to subtract intangibles? Okay, so this is very specific and practical, specific for banks. The regulatory capital is not only the shareholders' equity that you hold in your balance sheet, is the shareholders' equity minus intangibles, because this is what is considered the core capital for a bank that is measured according to international standards of Basel 1, 2, 3, and the financial sector-wide standards of quality of capital. In essence, what it means is if you have intangibles in your balance sheet for different reasons, if you have done acquisitions at higher prices than the value, and you have assumed some intangible value in your balance sheet, then you need to deduct this from your equity because it's not real capital. This is, in summary, the essence of what it means. I wouldn't expect Banco GNB or the valuation that you need to do to have any relevant intangibles. You only have relevant intangibles if you have done large acquisitions at prices very much above the equity level and that you would need to assume in your balance sheet. And a deduction of solvency capital according to regulators. Okay, not only Peruvian regulators, but worldwide regulators. Okay, let me finish this class with just a brief overview of the DDM. I will not go into detail. If you want me, if you are interested in this template, you can review it by yourself and you can ask me any questions if you like. Okay, so here, as I said, we have the balance sheet. For those of you that are interested in using it, you complete the key balance sheet items in the historical figures, both in the asset side and in the liability side. Okay, so the historic and the equity. You will have as an output, you also need to complete the historical figures of the key lines of the income statement, all the way down to net income. And then you will have in key assumptions as an output, the historical figures, the implied ratios of the different metrics coming from the balance sheet and the income statement above. And based on these implied ratios or key ratios in the historical figures, we are going to be projecting the balance sheet and the P&L. So for example, net loan growth, we are going to be assuming what it has grown in the past, and then we're going to be assuming an average or an expected growth based on the system. For example, for investments, we're going to be assuming that they are a percentage of loans, and we're going to be keeping this assumption in the future. And in that way, we're going to be projecting or filling in both the balance sheet and the P&L. Okay? Once we have your balance sheet and your P&L projected, we will be completing a balancing item in the balance sheet, so the balance sheet is balanced, okay? And we will use either interbank loans or interbank deposits to balance this line. Look at the formulas and you will understand better. And once you have your P&L and your balance sheet projected, we're going to be doing the DDM below. The DDM is done projecting the equity value, the risk-weighted assets, and the net income. Based on the minimum level of capital required, we're going to have either a positive or negative implied dividend, which we will discount at cost of equity, and we will come up with our valuation, our terminal value, and our dividends of the period, projected period. And for that value, we will have the implicit PEs and the implicit book value. Okay? So here you have a very nice template. A very nice template that will hopefully be useful for everyone if you ever need to evaluate a financial company quickly. If you need to do it in a lot more detail, well, you will need to fill it in or prepare it better or use a more complex template. Okay? So hopefully everyone has a clear idea of the different valuation, or at least clearer than at the beginning of the class, idea of the different valuation methods or approaches. Hopefully you also have a good idea of more or less what you need to do. I will email you right now your groups and what you need to do, and both the Excel and the PowerPoint, so that you can use as templates if you prefer. And let me know if you have any questions during the week. If not, I expect your slides next Tuesday before the class, in order for me to have them ready, available for you to present. I will ask you to decide who in your group you prefer to present, or if you want to present, you can divide the slides or the work, or do however you prefer. Try to split the work between the group. You shouldn't be spending a lot and long time doing this valuation. As I said, I want you to be practical. I want you to take the information that is available online, in Bloomberg if you have access, or via friends in investment banking if you have access to web pages or data sites, or if you are stuck and you don't know what to use or how to proceed, please send me an email and try to help you. Try to do it earlier rather than later, so I can help you properly and you can have enough time to prepare your slides. But I will try, at least during the presentations, to have a little bit more of communications and speaking from your side. Okay? So thank you all very much. See you next Tuesday, and let me know if you have any questions.